All right, today we're going to dive deep into a savings option that's a real favorite for people who value reliability. I'm talking about the Post Office Monthly Income Scheme, or as most people call it, MIS. So let's get right into what this is all about.
So let me ask you something. Are you trying to figure out a way to make your savings work for you? Turn a lump sum into a steady, predictable paycheck that shows up every single month. If that sounds like something you need, well, you're going to want to pay close attention. Because that's the exact problem this scheme was designed to solve. It's all about taking a chunk of your savings and turning it into a regular, dependable income you can count on. So how on earth does it do that?
Okay, at its heart, the MIS is a pretty simple agreement. You put a lump sum of money into the post office, and they, in return, pay you a fixed amount of interest every single month. It really is that straightforward. And the best part? It's backed by the government, which means your money is about as safe as it gets.
So who's the ideal person for this? Well, it's fantastic for retirees who are looking for a little extra cash flow to go along with their pension. It's also perfect for conservative investors, people who aren't looking to gamble with their money and would rather sleep well at night. Basically, if you just need a predictable bit of extra money coming in each month, this is definitely something you should look into.
All right, so let's say your interest is piqued. How do you actually get one of these accounts? The great news is that the whole process is surprisingly simple, and you can do it at pretty much any local post office.
And listen, you don't need to worry about a mountain of paperwork. You really just need three basic things: a couple of passport-sized photos, a copy of your Aadhaar card for your ID, and a copy of your PAN card. Oh, and if you don't have a PAN, a Form 60 works just fine. That's pretty much it.
Okay, now for the part I know you've been waiting for. The numbers. Let's talk about how much you can put in, what the limits are, and of course, what kind of return you can expect to see.
One of the absolute best things about this scheme is just how accessible it is. The barrier to entry is super low. You can open an MIS account with just 1,000 rupees. That makes it a real option for almost any saver out there.
Now, on the other end of the spectrum, what are the maximums? Well, if you open an account just for yourself, that's a single account, you can deposit up to 9 lakh rupees. But, and this is a really important detail, if you open a joint account, say with your spouse, that limit jumps way up to 15 lakh rupees. And that's not just about investing more. It can be a really smart way for couples to manage their finances together.
And here it is, the number you've been waiting for, the return. The current annual interest rate is a solid 7.4%. Now, just keep in mind, this rate is set for a specific period in 2024. The way it works is this annual interest gets calculated, and then it's divided up and paid out to you in those nice, equal monthly installments.
Now, if you're thinking, the post office, isn't that a little old-fashioned? Well, you might want to think again. Things have changed in a huge way, and managing your MIS account is actually incredibly convenient and modern now.
And this right here, is the reason why. This string of letters and numbers you see on the screen, IPS 00004DOP, this is the key. It's a single, universal IFSC code for every single post office in the country, and believe me, this one little code has totally changed the game.
So what does this magic code actually mean for you? Well, for starters, it means your monthly interest payment doesn't have to be collected from the post office. Nope. You can have it sent directly to your regular savings account at any bank using NEFT. It also means you get access to things you'd expect from a modern bank, like ATM withdrawals and even mobile and internet banking. It seriously brings the whole system into the 21st century.
Of course, life happens, right? Things can be unpredictable, so it's really important to know what your options are for getting your money out. Let's take a look at the maturity period and, more importantly, what happens if you need your cash early. So the MIS account has a 5-year lifespan, or maturity period. Think of it like this. For that very first year, your money is completely locked in. But after that first year, you can take it out early, but there is a penalty. If you withdraw between year 1 and year 3, there's a 2% penalty on your original deposit. If you wait until after year 3 but before year 5, that penalty drops to just 1%. Then, once you hit that 5-year mark, the account matures and you get your entire principal back, no penalties at all.
And just so you can see it for yourself, here's the official rule right from the source. It lays it out pretty clearly. A 2% deduction if you close the account between 1 and 3 years, and a 1% deduction if you close it between 3 and 5 years. It's just one of those key details you want to be aware of before you jump in.
The scheme also has a very clear plan for the worst-case scenario, which is important. If the account holder passes away, the account is simply closed.
The full amount is then paid out to whoever you've chosen as your nominee, or to your legal heir. It's a straightforward process that makes sure your money is protected for your family.
So, if you remember anything from this, let it be these three things. First, safety. This thing is backed by the government, giving you a real peace of mind. Second, regularity. You get a fixed, predictable income every single month, like clockwork. And third, convenience. It's now fully plugged into modern banking, which makes managing your money a breeze.
And that really brings us to the final thought I want to leave you with. When you look at that combination of safety and predictability, you have to ask yourself, could a reliable income stream like this be the right foundation to help you build your own financial goals? It's definitely something worth thinking about.